Welcome back. Taking a look at some of your business news now. And South Africa is still at risk of a sovereign credit rating downgrade this year. This on the back of weak economic growth prospects and political tensions. Ratings agency S&P Global has South Africa on a BBB rating with a negative outlook, one level above junk status.
S&P Global says it would lower the ratings if GDP growth and fiscal consolidation do not improve in line with current expectations. The ratings agency says political infightings and interference may be perceived as weakening institutions. But South Africa could have its ratings raised if policy implementation leads to improved business confidence and increased investment in the private sector. Ratings agencies also want to see higher GDP growth and improving fiscal dynamics.
We are still seeing risks from lower pace of economic growth. We are still seeing risks from political tensions that may impact on government's policy framework, policy implementation to turn around the economic growth path. We are still seeing risks from the fiscal consolidation that could be impacted from the lower pace of economic growth or increasing risks from contingent liabilities.
Some economists say South Africa is still on a knife's edge where ratings are concerned.
In last year, 0.3% growth did disappoint, South Africans and I think the credit ratings agencies as well. And looking ahead for 2017, we must show growth at least in the order of 1.2 to 1.5%, I think, to be safe in terms of our credit rating. And today again, S&P reiterated they want to see the growth coming through that will boost confidence, that will result in investment, that will alleviate our fiscal scenario. So I think unless we're going to see the growth, the chances is still good that we might see a credit rating downgrade somewhere during the course of 2017.
Globally, economic growth prospects are improving, but risks remain on the political side. S&P Global says possible protectionist policies could impact negatively on emerging markets.
Emerging markets would be directly vulnerable to increased protectionism in developed markets. If you take the case of the US, the most directly exposed countries would be in South and Central America, of course. But we should not underestimate the second round effects, with slower growth in some parts of the world that would have a spillover effect in other markets, including Middle East and Africa, and Asia, of course. So certainly we are quite concerned that such measures are not implemented. That would be detrimental for those who take those measures and those who are directly the victims of those measures.
S&P Global is expected to publish its review of South Africa in June. SABC News, Johannesburg.